markets have been quite volatile lately, driven by global factors and interest rate shifts. How are you looking at managing the Balanced Advantage Fund?
Balanced Advantage Fund, as the name suggests, dynamically adjusts the equity allocation depending on the valuation of the market. Sometimes you get into a territory where market is overly pessimistic. That is when the equity allocation needs to be the highest.
Many investors struggle in timing the market. How do you think Balanced Advantage Fund helps investors manage their portfolio better?
Balanced Advantage Fund cuts out the emotional part of the decision making, which is the toughest part.
Welcome to the 12th episode of Fundamentals. On this episode, we will take a closer look at how investors can navigate volatile markets through asset allocation. Today, we will cover Balanced Advantage Fund with our CIO, Mr. Rahul Singh. So, Balanced Advantage funds have been seeing rising investor interest over the longer period of time. For those investors who are looking to dynamically allocate their assets to equity and debt. So, our markets have been quite volatile lately, driven by global factors and interest rate shifts. In this market scenario, how are you looking at managing the Balanced Advantage Fund and how are your allocations been?
Yeah, hi. So I think Balanced Advantage Fund, as the name suggests, dynamically adjusts the equity allocation depending on the valuation of the market. Not so much the macro fundamentals, but the valuations of the market. And therefore, I think what we have seen in the last say 1.5 to 2 years is that because the markets have been volatile and range bound and moved sideways, we've had opportunities to change, do minor allocations to equity and generate alpha from that. That is number one. Number two is that the valuations have been on a downward trend since the last 2 years. So we are now looking at a period where while the valuations are not the cheapest, but it is not as expensive as it was a few months ago, and therefore the allocation has adjusted to that. And this is the best part about dynamic asset allocation funds. So depending on the market outlook and what the market's expectations are, sometimes you get into a territory where market is overly pessimistic, and that gets reflected in the valuation ratio, and that is when the equity allocation needs to be the highest. So it is a contra kind of an approach to investing, which is not usually what you see in a normal human behavior. So what the Balanced Advantage Fund intends to do is to take advantage of such periods and do the right thing for the investor, rather than getting swayed by emotion and not investing when you should be investing more into equities. So I think that is what Balanced Advantage Fund does. And today, as I mentioned, I think the valuations have normalized. So the asset allocation to equities is not the highest, but it is also not the lowest. So it's somewhere in the middle, and I think that's a good space to be in.
Definitely. Thanks for explaining how the model actually works and the importance of valuations in this fund. What are the other key factors that you take into consideration while building this portfolio?
So I think the other considerations are basically within the equity allocation, how you position your weightages in different sectors. So that's the second layer. But at the first layer, I think the considerations are based on what is the model you have to predict what allocation will work. So our model, for example, in Tata Balanced Advantage Fund works on a combination of the trailing P ratio and the forward P ratio, because that I think captures the valuation sentiment or the market sentiment very adequately if you take an average of the two. And based on what is your average, we have decided certain bands, and using those bands, we decide what the equity allocation should be. Whether it should be 40%, 50%, 60, 70, 80. So the range is between 40 to 80%. That is the first level, what I call as the fundamental level of equity allocation model. On top of it, we try and optimize it using a set of 5 technical volatility and momentum indicators, which sit on top of the first part of the model. So if we feel that basis the second part of the model, the allocation needs to be higher by 5% or lower by 5% on top of what gets decided by the PE ratio, then we do that as well. And we have found that a combination of these two factors or these two parts in the model has actually worked quite well for us, because it's like combining the best of both worlds, the quant world as well as the fundamental world. We give higher weightage to the fundamental PE based ratios for allocation, but we also keep some room for the technical and the momentum driven factors to make sure we are not missing any short term signals which the second part of the model might throw out.
That's quite comprehensive. You briefly touched upon sectors as well. Could you let us know your view on which sectors you're currently constructive on?
Well, today I think the best sectors, according to us, is the BFSI, where obviously because of the low base in the net interest margins and the credit growth, and both are looking up while the credit costs are benign. So I think that's a clear favorite for us. The other sectors which are looking good are the resources and energy sector. And the entire space, because of a little bit of an impact from AI, but also what's happening globally in terms of the de-dollarization and the fight for natural resources, which is getting weaponized or nationalized, so to say. So I think resources and energy, including power, would be the other sector. And then it's no longer a counter bet. It's something like what it's already showing results in terms of the behavior or the pricing behavior in these industries. And the other sector where we think we could have a resurgence of interest is the power sector. And lastly, I would say one of the sectors which we like, which has not performed, but it's a kind of a contra bet, is the cement sector.
So typically, many investors struggle in timing the market. How do you think Balanced Advantage Fund as a category helps investors manage their portfolio better?
I think Balanced Advantage Fund cuts out the emotion part of the decision making, the emotional part of the decision making, which is the toughest part. Because when the markets are down, you need to be actually investing more. But typically what happens at the individual level is you would get more risk averse and you would probably avoid and you would probably sell at the wrong time. And a Balanced Advantage Fund does not allow you to do that because it's model driven. Automatically, in my case, the allocations to equities would be going up. So the investor does not have to worry about depending on his or her decision making during times of stress. Whereas because the model is taking care of it, so it's a great product to see through these times, and it's a product which should be a core part of everyone's portfolio because it gives you a stability in the portfolio and not expose you to the unnecessary equity risk, and this is the best part. So in our view, this along with the other hybrid categories like multi-asset should form a very, very strong core part of everyone's allocation. And the allocation to equity is dynamic. So even if there's an opportunity and the valuations come down, we will be able to take advantage of that in this fund, which may not always be possible if you're managing the asset allocation yourself.
Right. So for a typical investor looking to invest in a 3 to 5 year horizon, how do you think the Balanced Advantage Fund return and volatility metrics will shape up for them?
Well, I think the risk-adjusted returns for BAF or Balanced Advantage Fund is what we should focus on. And typically, when we talk about this fund, we always talk about fixed deposit plus a few basis points kind of return at equity taxation. I think that is what investors should keep in mind. So while you get equity taxation and you get lower volatility, you are making returns which are materially in excess of, say, the fixed deposit returns. And that is what I think gives stability to anyone's portfolio. You might have your pure equity funds, your small cap funds, and your mid cap funds, but this part of the portfolio would give you returns which are more predictable and more steady kind of returns.
Thank you, Rahul, for that. Just one last question before we wrap up. From an outlook perspective, what are your expectations for, say, the next 12 to 18 months?
Well, I think the valuations have corrected. I think if you started in 2024, forward P ratio for Nifty 50 was 23 times, now it's 20 times. Mid cap and small caps were trading at anywhere between 40% to 80% premium to large caps. Those premiums have come down to 10 to 30%. Our own premium for the Indian markets versus other emerging markets used to be at 90% in middle of 2024. That has come down to 50%. So a lot of, I would say, valuation normalization has happened. And I won't be excited just by that, but also the fact that growth seems to be picking up in terms of the profit growth or the corporate sector profit growth. One is GDP growth, credit growth, like I mentioned, commodity prices are reviving, so that also supports corporate earnings. Consumption is coming back thanks to the government effort toward boosting consumption. And I think if you put all of that together, you are going to see a return to a normal kind of an earnings growth, which we were seeing pre-2024. So if you combine the valuations which are normalized now and you look at the higher growth or growth coming back, you are going to see, I think, more steadier times in equities over the next 12 to 18 months than what we have seen in the last 18 to 24 months.
Thank you, Rahul, for your insights on the Balanced Advantage Fund, and look forward to continue chatting and getting more insights from you.
Sure, Akshay. Thank you.
Thank you. Thank you for joining today's episode. Stay tuned for more insights on how Tata Balanced Advantage Fund aims to deliver stability through market cycles. Thank you for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.